In this video, we're going to discuss the process of executing zero DTE trades, better known as day trading with options using the SPX. We're going to discuss the process of putting on the trade, the steps you should take before you put on the trade, because that's the only time that you can control everything about the trade is when you're initiating the trade. You can control absolutely everything when you're initiating a trade. So it's to your advantage. It's in your benefit that you take advantage of that, that you make sure you set the trade up as best as possible to give you super high probabilities of winning. Because once the trade is on, then you are reacting to the market. You are on defense, is what we like to call it. You're no longer on offense. The market is dictating things at that point. So for for you to win, it's this old adage, the best defense is a is a really good offense. Well, you're going to need a really good offense when you are trading the zero DTE process. And so we teach the zero DTE process at a super high level here at the Dorian Trader. We have a statistical day trading course by Dr. Metals that you can learn from. We have a number of members who have pointed to that as changing the game for them so they can be successful at day trading options. So we're going to put a link to that in the description area. But in this video, we're going to kind of give you a quick little overview. So kind of get your interest or spark your interest in the trade, because this trade is the most lucrative options trading strategy out there. When all else is equal, this trade is the most lucrative. You can make so much money trading this zero DT strategy that we're about to review. So, but you can also lose the most because it's the most risky. It's a risk reward type of scenario. But if you learn the process correctly, you can eliminate a lot of the risk. You can lose a percentage that you can manage, that you can handle. But if you don't learn the process correctly, like most people, they jump into this trade and they don't understand all the nuances about it, and they wind up blowing up their account. So at the Dorian Trader, we try to prevent people from doing that. We try to emphasize that it's important you learn every step of the trade, how to put it on, right? All the things that's considered when you put it on, how to put your stop loss, what happens once you get stopped out, all of those type of processes that you need to understand before you do the trade. And so if you do not know how to put on trades or put on a stop loss or adjust trades, then you have no business trading this zero DTE strategy, because you will wind up killing your account, and that would be very unfortunate, because it doesn't take a long time for you to learn this process. You just have to put in the time. You have to put in the work. You can't be a lazy trader and expect to make thousands of dollars a month to be able to supplement or make it your primary source of income, and just roll out of bed, push some buttons, and next thing you know, you are a full-time trader making a ton of money. It just doesn't work that way. But do you have to go back to school? Do you have to go back to a 4-year college to be able to learn this process? No, you don't. But you're going to have to put in some time. We believe most people can get it done if they really put in the work. They can be excellent at this in 6 months, and just fantastic at it in 12 months. So is 12 months too long for you? You have to ask that question for you, right? Do you need to make a certain amount of money immediately? Well, if that's the case, then zero DT trading is not for you, because this process is it's a hurdle. You have to learn the process, or you're going to destroy your account. Okay? You're going to destroy your account. All right. So with that said, let's take a look at the screen here, and let's talk about the process of putting on this trade. So at the Dorian Trader, we tell people that you want to start off by looking at the VIX, the cash settled VIX. And keep in mind that this is the weekend that we're recording this. So the markets are closed. So we're going to be using a 3 days to expiration. But it's the things we're going to talk about still apply. But keep in mind, when you're doing this trade, it's only going to be 0 day, meaning it's not going to be any time left. It's going to expire that day. Okay? So when we are initiating a zero DTE trade, we look at the VIX first, the cash settled VIX, the VIX, and we do what we call the rule of 16. And we take that VIX number and we divide it by 16. So this is the number here, the 1384. So we take that 1384 and we divide it by 16. And that's going to give us a expected percentage move that's going to give us about 0.86%. And this is basically the 2 times expected move for that day. Right? So we take that to just kind of have an understanding of how far we want to be. If possible, we want to be at least 0.86% away, if all possible. So then what we do is we go and look at the expected move based on doing a straddle price. So we buy the straddle, as you can see on the screen here, and on the TastyTrade platform, the straddle price is saying 40, so we round that up and say 32, and then we match that against the TastyTrade's platform expected move. Now the TastyTrade platform is an excellent platform. We love it. We love to demonstrate on it, love to trade with it. They have their own formula of determining the expected move, and this expected move on the TastyTrade platform is basically saying just under 29. So at the Dorian Trader, we take the higher number and then we times it by 2 to be able to determine where we want to start our position at. Okay, so if we take in this number, this 3140, rounding it to 32, so if we take 32 times 2, that's going to be 64. So what we're going to do is take that 64 number and we're going to add it to the last price. And then we're going to subtract it from this last price to be able to get our call short strike and our put short strike. So in this case, if we took the 44.57 and we added 64 to it, that would take us to 45.21 on the call side. So we don't have a 45.21, but we do have a 45.20, so we're gonna put it there. And so when you're putting on a spread, you can decide which width you want to do of that spread. You can do a 10-point wide, a 20-point wide, a 30-point wide, a 50-point wide, or even something wider. But what I normally do is put it in at about 20 points wide. So in this case, we're going to put 20 points wide. And then on the put side, we're going to do the same thing. We're going to take the 44.57 and we're going to minus the 64. That's the 2 times expected move. So that's going to give us 43.93. So we can either choose the 43.95 or the 43.90. In this case, I'm going to choose the 43.95 and I'm going to do a 20-point wide spread. So in this example, once again, this is a 3-day. This is 3 days to expiration, so it's not apples to apples, but it's pretty much the same thing, except it's going to be no time to expiration. It's going to be a 0 DTE trade. But what you're trying to collect is, if possible, $100 on both sides, or $200 per contract that you do, or per iron condor. You can also, especially in this environment or in a low volatility environment, you can also take less than that. So some of our members are doing as little as $50 per iron condor contract. So in this example, we have 135. That's how much we're collecting. That's excellent. If you wanted to take some of that away, let's say you were getting that, you can always move away and put your put side further away. Keep it 20 points wide. So this is 115 now. You can decide that if you want to move your call side away some more, you can do that. And so this is $95 per iron condor contract. So once you do this, then what we teach in the statistical day trading course is to put your stop. So you can put your stop the way Dr. Meadows in the statistical day trading course teaches, is on the short leg. You can put the short leg on the call side and then a second stop on the short leg on the put side. You can also put your stop loss on the entire put side spread, and then you can also put your stop loss on the entire call side spread. We do not recommend you put the stop loss on the entire iron condor, because you're always going to have one of the sides that's not being tested at all. It's going to be a very low delta, and that's going to cause you to have a problem to get out, because maybe one of the bids are a 0 bid or no bid on it. And so to always be able to get out of a trade, you want to put the stop loss on the short legs only, or on individual spreads, the put side spread or the call side spread, never on the entire iron condor itself. Now, when you're doing these 0 DT trades, we encourage you to use a stop loss, right? To use a stop loss. When we teach at the Dorian Trader, the 1 DT trade or the 7 DT trade, or trades that's longer term, we're not encouraging a stop loss. But on the 0 DT trades, we encourage you to have it, especially if you do not know how to adjust at a super high level. We do have some members that know how to adjust at a super high level and have the discipline to be able to trade these 0 DT trades without putting an actual physical stop loss. They have more of a mental or a certain delta stop loss, and that's okay for people who have demonstrated the ability to be disciplined and not blow up their account. But most can't. So we encourage everyone to have a stop loss, and then you can come back in and make your adjustments as we teach in the statistical day trading course. If you do not know how to come back into a 0 DT trade and you're only using a stop loss, then you're not going to be as profitable on this trade. In this lower environment with the market kind of moving a decent amount each day or almost every day, you can have a problem, especially if you're trying to collect more than $75 per iron condor. If you're trying to collect $50 and you are at a 4 or 5 delta on both sides, you're at that VIX percentage move that's expected or further away, then you could have a super high probability of winning without having to do anything but put your stop loss. But your stop loss is going to have to be at a correct percentage number or times your credit you receive. So at the Dorian Trader, we teach 3 times the credit or 4 times the credit. Me personally, I like 4 times the credit to let the trade kind of play out longer, but most of our members like the 3 times stop loss. Okay, 3 times the credit you receive, stop loss. All right, so this is what we wanted to discuss in this video, but we encourage you to learn more by looking into the Statistical Day Trading course. We can encourage you to learn more by joining our trading club. If you like this video, please subscribe to our channel, and hopefully we'll see you in another video. Bye for now.